Hi. First of all, thank you all for the time today. But this question is directed towards Geoff in particular. Several years ago, you had given a write-up on Japanese net-nets, and a key focus of that write-up was on the difference in the retained earnings yield between the U.S. and Japan, and a lot of that was driven by inflation differentials. I'm curious because back when you wrote this up, Japanese inflation was basically zero, non-existent. And I'm curious if, because now Japanese inflation is running in the 3 to 4% range, if this changes structurally or temporarily your view of the retained earnings yield, the differences between the U.S. and Japan, and if you think elevated inflation in Japan changes the business quality or the earnings quality of the net-nets.
Yeah, I mean, I think potentially some inflation in Japan could be good for a lot of businesses that have been pretty boring ones that have been overlooked there. I think a big reason is that difference between them has obscured the fact that some of the companies that grow at a low percentage in the U.S. are actually growing in real terms pretty similar to these Japanese companies. Where it might hurt, though, is there's some very safe Japanese stocks that have good dividend yields. I mean, Berkshire is basically doing a spread business there now, and that could be impacted a lot because so far it doesn't look like real yields are going to look that good.
Great. Thank you.